Welcome to The Explainer. Today, we're going to decode the language of business health. We are talking about financial ratios, these amazing tools that can turn a confusing sea of numbers into a really clear, compelling story. So, for a lot of us, right, opening a financial statement feels, well, it feels like this. It's just an overwhelming wall of numbers, kind of a dense fog of data where you don't even know where to start. You're getting hit with all these terms like current assets, gross profit, net worth, and it is so easy to get lost in all of it. But what if you had a magnifying glass? A tool that could bring the really crucial details into focus and help it all make sense. Well, that tool is the financial ratio. It's designed specifically to create clarity out of all that complexity by finding the meaningful relationships that are hiding behind the numbers. Here's a perfect example of how it works. Instead of trying to compare two large, kind of abstract numbers in your head, a ratio just boils them down to a single powerful insight. It literally transforms that raw data into intelligence you can actually use. So instead of juggling $266,000 and $133,000, you just get a simple relationship, 2-to-1. And that clarity tells you something immediate and really important about the health of the business. And these ratios are expressed in a few really simple ways. Whether it's X to 1, or as a percentage, or even a cents on the dollar. Every single format is designed to make the financial condition underneath it all super easy to grasp and to share. Okay, this brings us to the two main ways you're going to use ratios. A single ratio, that's just a snapshot, a picture of your business at this exact moment. But the real power, and I mean the real power, gets unlocked when you compare that same ratio over time. That's when you see the trend, and that's where the story really starts to unfold. All right, let's move on to our first set of clues. These come exclusively from the balance sheet, and they tell us all about a company's fundamental structure and, its stability. So a classic example is the current ratio. You take your current assets, you divide them by your current liabilities, and it answers one simple, absolutely vital question. Can you cover your short-term debts with the resources you have on hand right now? Now, the industry benchmark for a healthy business is typically 2-to-1. What that means is you have $2 in easily accessible assets for every single dollar of debt that's coming due. It's a crucial safety net, a buffer that signals real financial stability. Okay, this is where the investigation gets even deeper. We start connecting clues from the balance sheet with clues from the income statement. This is how we start to see the link between what a company owns and what it earns. In other words, how efficiently is it actually using its assets? But, and this is a really critical rule, you can't just divide any two numbers you see. The accounts have to have a logical relationship. For example, comparing your total sales to the value of your office building, that tells you absolutely nothing. The connection has to be meaningful. For instance, if you compare your sales, which are at market price, to your inventory, which is at cost, you're going to get a skewed result. It's not apples to apples. So to get a true comparison, you use what's called a real turnover ratio, which compares the cost of the goods you sold to the cost of your inventory. So let's say you run the numbers and your business finds its inventory turnover is 7 for the year. Okay, a clean, simple figure. But what does that number 7 really tell us? 7 times so what? What's the actual story behind that one little figure? Well, it tells you two incredibly important things. First, it means you sold and then replaced your entire stock of inventory 7 times over the course of the year. And second, it's a direct measure of your operational efficiency. A higher number usually means you're not tying up a bunch of cash in goods that are just sitting on a shelf. Okay, our final category of clues comes purely from the income statement. And these ratios, they cut right to the chase. They measure the ultimate goal of pretty much any business, profitability. A key ratio here is net income to sales. It's super simple. Just divide your net income by your total sales. This tells you exactly how much of every single dollar that comes in the door you actually get to keep as profit after every single expense has been paid. It's your true margin. All right, so now we have all of our tools. Let's talk about how to use them together to get the full story, to really see the entire picture of what's going on. And remember this. A single ratio is just one clue. It's not the conclusion. Knowing that 95% of your sales are on credit, that's an interesting fact. But knowing that figure jumped up from 65% last year, that tells a story. That reveals a huge shift in your business, and it forces you to ask why. That is the power of analyzing the trend. And look, while comparing your numbers to industry averages can be kind of interesting, the most valuable analysis always comes from looking inward. The real goal is to track your own trends and establish your own standards for what healthy actually means for your unique business. Ultimately, that's the real power of this whole thing. Financial ratios turn these sterile, boring numbers into a living, breathing narrative. They let you read the story of your business, to understand where it's been, and, most importantly, they give you the insights you need to decide where it's going next.